Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only and amazing Anna Kelly. How you doing, Anna?
I'm doing great. Great to be here with you today.
Yeah, this is a really important series of interviews today. The first one I've been waiting for our discussion. I don't know. I'm sure you've seen it, but I'm just going to coach the audience. So I've heard a lot over the last 3 or 4 days that the yield curve inversion is the worst since 1981, right?
Yes.
There's a lot of talk about what we're heading into is very much like 81. And 81, for people that don't know, is often quoted as when we got Paul Volcker. So, as you know, I have this thing that I spent a day of my life putting together called the 52-year spreadsheet. So I thought we should go back and look at 1980, 1981, and 82 just to see what happened when the yield curve was even worse than it is today. So, what do you think about that?
That sounds great. I was just going to say, let's talk about the yield curve because it is the worst and the most inverted since the 1980s. So 40 years ago, it's hard to believe it's been that long, but let's do it.
Yeah, and again, the reason this is important because there's a lot of analysts that I watch that frankly are my age, which means they were not adults in 1980, right? They were kids
Right.
like myself. So a lot of people I think are reacting to their last 20 or 30 years, and we didn't have inflation. We didn't have this massive yield curve inversion. So I think making statements based on your 20 years of track record, even if you're the best of the best without going back to the early 80s, is a mistake. So that's what I thought we should do. So let me bring it up.
Love it. Yeah. And most people only really look back two or three. Most people don't even look back 10, right? Because they've only seen 2 or 3 or 4 years of really great things. It's hard for them to imagine anything going back in time, but history
Yeah. So
definitely leaves clues.
it does it. It at least you should, even if you think this time is different, which I think are very dangerous words, you should at least go back. If you're going to say it's the worst since 81, well, you might want to go look at 1980, 81, and 82 just to see what happened. I mean,
Right.
what the heck, right? So just so everybody knows, you know this, but just in case you're a first time viewer, this spreadsheet is 52 years in the making. I built it over a year ago and we've added to it. Goes all the way back to 1970. All the data sources are linked here. So if you want to, check the numbers I got, maybe fat fingered a number or whatever, but all of them are here. These are not my numbers. These are numbers from other places. But again, let's go back. Let's scroll over so it's easiest. I thought we'd go back and look at 80, 81, and 82. Does that make sense?
Makes sense.
So again, the first thing that I wanted to look at was what was happening to interest rates. Because again, was a lot of talk about, hey, this is the fastest time. Interest rates are up 300 basis points. Well, you know what? They were up almost 300 basis points from 1980 to 81. Now, on a percentage basis, today is much worse, right? 0 to 3.5. Much.
Right.
I'm not confused, but we have seen this run up before,
Yes.
right? Other thing I wanted to look at was unemployment rate, right? Again, unemployment was significantly higher, and it didn't actually go up that much. It only went up half a point, or actually zero point 0.4, but it went up big in 82, right? Because again, you and I know this. Anytime there's a monetary or Fed change, it's a delay, right? There's a delay of pain. So anything that happened in 81, the pain probably, at least on the unemployment, was felt in 82. So, up 200 basis points.
Right. And it probably goes without saying, but the reason that it's so similar is because we were dealing with massive inflation in the late 1970s leading up to the early 1980s. And that's why rates started to go up because the Fed Volcker was trying to kill inflation. And it is why that dipped us into recession and increased unemployment.
Yep. And here's the CPI rate. I went back to 78. We can go back further, but yeah, CPI was a problem. It peaked in 80 at 13 when Paul Volcker finally had enough. And he did what he did. He took interest rates on the 30-year mortgage to what was it, 16%, I think? Yeah, 16.6%.
Right.
Now, because let's look at stocks first. So stocks were negative, or actually, where are they? Here they go. They went up slightly from 80 to 81, I guess. I don't know, what is that, 20% actually? And then they went down in 82. Again, this is the S&P 500. It's hard to
Mhm.
believe the S&P 500 was 100. Today it's
Yeah.
like 4,000. Oh,
Right.
inflation, tell you.
Exactly.
But what I wanted to look at was housing. Because again, I'm a housing investor and I think a lot of people, right? So if you're coming into 79, housing went down, new construction went down about 50%. Makes total sense, right? Housing went
Right.
down. Existing home sales again went down 50%, right, from 3.8 to 1.9.
Right.
And then the last thing that really jumped out at me was this number right here. Housing affordability 1981. It was the worst on record, right? So
Yes.
again, you know, I think 1981 is very similar to 2022 or 2023, right? We have a rising rate environment. We have horrible affordability.
Right.
We have a Fed that's being aggressive. We have inflation that's a problem. And then, oh, by the way, what happened to appreciation? This is what drives me crazy is people don't understand that, yes, you can have transactions fall 50%. Yes, you can have interest rates go up 300 basis points. And people are acting like home appreciation has to go down 30%. And it doesn't. It may happen in a few cities, but nationally it might not. And that's what this says. I'm not saying it will go up these numbers. I'm just saying people are acting like it's a foregone conclusion. And I'm like, that might not be true.
Right. Right. And I bet you there was a whole lot of people back then, similarly to today, that just simply decide, I'm not moving, right? If you don't have to move, they don't have to move. And if you minimize supply, then prices can stay elevated even if demand is waning as well. And so many people talk about the demand waning and the affordability issue, but that also really impacts how many people are willing and able to move, to step up. Right now, my goodness, you have to pay more money just to step down. And so most people are staying put. And so that could keep us, and this is a really good picture of that, from really having a crash in prices. We will have a crash in transactions, like you and I have been saying for a year, right?
Yeah.
But the price appreciation may slow, but across the U.S., it may not actually decline.
Yeah, I think it's going to be really sticky, a lot more sticky than people think. Again, the other thing that's really important here is, see, it says nominal home appreciation.
Yes.
Just because I'm a geek with numbers, you can actually
Yes.
go back here and look at the adjusted. It did go negative in real terms,
Yes.
but I don't know about you, but my debt's in nominal terms, right? It's
Right.
fixed for 30 years. So again, a lot of people talking nominal. And again, I'm not saying prices can't come down. I'm just saying go back and appreciate history. And I think your point is exactly the right one. We're going to have less demand. It's unaffordable, just like it was in 81. And you're going to have supply destruction, which all of these YouTubers and 20-year veterans don't appreciate. We haven't had supply restriction, interest rate lock-in, whatever you want to call it, since the early 80s. People just
Right.
won't move.
Right.
Yeah.
Absolutely. And in areas where there are a lot of jobs and good wages, people absolutely will not move. They have no reason to change jobs. They'll just stay put, right? If you are in a job in a small town and you have to move, those areas, because there's not a lot of jobs, may be the ones that have people have to move. Prices start to come down a little more. But if you're in resilient local economies with great jobs, good schools, low crime, et cetera, you would be crazy to move, even for a job, because it's going to cost you so much to live there, whether you're renting or whether you're owning, than where you live today. And the additional wage that you might get by moving across the country may not be sufficient to offset your additional cost of living because of housing affordability.
Yeah, and again, one more thing that I think is going to be very unique about this kind of 2 or 3 year period is the 30-year debt is now an asset, right? If you're one of the 13% of folks that have something below 3, that's an asset. If you're one of the 51% below 4, that's an asset. And what do I mean by that? Let's just say you have to move to another state, but you have one of these 2.8% mortgages. I'm willing to bet that more than 30 or 40% of people will rent that home out and rent in the new space. It makes financial sense.
Right.
People can do arithmetic and they're going to say, you know what? I'm going to rent my house out. I'm going to put $500 in my pocket a month. It's going to help pay for my rent in the next place while I save for another down payment. So yeah, supply destruction is the missing ingredient. And I don't think people appreciate it. And again, I'm not saying prices can't come down kind of in iBuyer cities, or maybe some luxury homes that were overbuilt come down. But when you look at the median home price, which is all I talk about,
Right.
I think it's going to surprise people at how sticky it is.
Absolutely. I agree with you. And there's always certain cities that kind of boom or bust. They boom first, significant
Phoenix,
amount of
Vegas.
yeah, exactly. And those prices are already starting to come down, but there's been overdevelopment. And what's happened, a lot of people haven't really appreciated is that you had all this demand, all these people migrating into those areas, but that demand migration has stopped, right? And so now you have supply that was built for future demand. You may not have the influx of people from California, right? I like to pick on California. They're the ones moving to Nevada and Arizona and Texas,
I
right?
agree.
But a lot of that post-COVID migration has stopped or slowed down. And because of affordability, it will. So, if you were building for future demand, assuming that was going to always stay, now you've got this double whammy of people not moving for jobs, not moving because of COVID, and not moving because of affordability. Those are the areas that are going to definitely have some pain, as Powell likes to say, some pain, right? Never know how much, but there will be some. But there's other markets that it's all about supply and demand. And if there's still a lot of people moving into the area, still a lot of new jobs being brought online, then those markets are going to have continued demand and additional supply that hasn't yet caught up and exceeded demand. They're going to be resilient. And I expect appreciation to continue in those markets.
Yeah, I agree. Again, folks, I think you would do yourself. I mean, if you haven't gotten the spreadsheet, which, oh, by the way, we give away for free, just there's a link below to my free course. It's on Teachable. Go get it. Scroll down to the bonus section. It's right there. I think it's so valuable. It's there for you. If you think it's the worst since 1981, go back and look at it. There's, I don't know, 25 different economic metrics. All the data sources are linked. Go look at 80, 81, 82. Look at the misery index. Look at these different things. It's going to be a rough year, but I think a lot of people are putting dominoes together that aren't actually aligned. And I think it's dangerous to do that.
Yeah, the spreadsheet is an amazing tool. It's amazing that you're giving it away for free, Michael, because it takes all the data, weeds through all the noise and the news and all the research and puts it all right there for you to see. So it's really insightful. I'm glad we've been able to look at it together over the last year.
Thank you very much. Anna, where can people find you?
Great. You can find me here every week and on my playlist. You can find me at social media at Anna Kelly REI Mom and my website, reimom.com.
Thank you so much.